Hi, everybody. Thank you very much for joining us today. We are thrilled to have Lisa Williams, who is going to speak about making lots of money and being financially free and some ways to do it.
I love it. Peggy, thank you so much for having me. I think this community is amazing, and I'm curious, raise of hands for who is a wealth builder already, or maybe who is looking to be a wealth builder.
What does that even mean? What does that mean? Sorry.
In my mind, wealth building is actually 90% mindset, actually, and it's about 10% skill set. I think anyone can learn to be a wealth builder. And, some people just have a tendency to tap into the money-making side of our brain a little bit easier. Maybe it just comes more naturally. Peggy's one of those people, right? But I in particular have the blessing to be part of an organization that's what we focus on, is we help people at my firm move their way around the cash flow quadrant. Those of you, raise of hands for who has read Rich Dad, Poor Dad or Think and Grow Rich. Most people in these communities, they've read all of them, right? And I am very passionate about helping people move their way around the cash flow quadrant. And this actually came from my own financial journey. Anyone ever find themselves in a place where maybe money was lacking? They were in a situation financially that didn't expect to find themselves. Maybe there wasn't enough money to go around. For me personally, that was 18 years ago. I was a single mom very unexpectedly. I had a 3-month-old and a 3-year-old. And I was always good at making money, but I had no idea what to do with it personally, because I had left that in the hands of my husband, who was no longer with me. So I became a student of money at that time. And it started for me at a class that I took at church. For you Dave Ramsey alum out there, this is a Financial Peace University class, but it really started my brain working around there's so many ways to make money. And I've probably done it all, but one in particular that I really find passion around is the concept of helping people create their own bank. So this group in particular, as I understand, is heavily real estate focused. Is that right, Peggy? That's your primary bread and butter, would you say?
All areas of real estate.
Okay.
Not our bread and butter, but this show is all about education in all aspects of real estate and any way to make money.
I love it. Okay, super. So raise of hands for anyone that has heard of the concept of infinite banking or be your own banker.
Everybody on this call is involved in some way in that.
And how many of you are actually, how many of you actually have your own bank now? Out of curiosity?
You mean my husband?
What's that?
I said, you mean my husband? Yeah, I do have
it. I hear you. So
well, I'm not sure if I would say I have my own bank, but I've been a hard money lender. Does that count?
In a sense, yeah, but it's a little bit different than the concept I'm gonna teach you about. Okay, so some of this may be familiar to many of you. Some people, it may be an entirely new concept, but this is a concept that I learned about back in 2008 after the financial services crash. What I didn't tell you was after that, 18 years ago, I became really fascinated about investing. And by the age of 47, I had accumulated just over 2 million in assets myself, and I retired from my corporate gig. Okay. But what I did step into is my blessing to be a wealth educator. So I'm very privileged to be here. And Peggy, thank you for welcoming me into your community. And I'm going to do my best to share some things with you that you might not already know about being your own bank, and also encourage you to take action on this area if you haven't already in your life. Because raise of hands for anyone that thinks there's some messing around going on with our taxes in this country and our wealth building, and maybe some challenges in our wealth building because of changes possibly in taxes. So, if that right there alone doesn't kind of have a lean in moment for you, then I don't know what's going to. But let's just talk first of all about, I want to ask you some questions. So first of all, are you where you thought you'd be financially at this point in your life?
Absolutely.
Yeah. And for a lot of people, maybe I have some catching up to do. Maybe I'm ahead of the game. And the second question to ask yourself is, do you have some lazy assets that maybe could be working better for you? Maybe are there some funds that you're using that using other people's money, the bank's money, when you could actually be using your own money? You could be putting your money to work in a better way. Okay. Another question to ask is, do you have children or maybe grandchildren in your life that you'd like to create a legacy for? This obviously, this group, that's a big part of the Nest Egg Builder community, which I love. Now, I am a huge fan of Robert Kiyosaki, and in particular, a very not as well-known woman who actually co-wrote Rich Dad Poor Dad, Sharon Lechter, who is a mentor of mine. But both of them, they're teachers of financial education, as you probably know. And I love this quote: the main reason people struggle financially is because they've spent years in school, but they've learned absolutely nothing about money. And the result is that people learn to work for money, but never have money work for them. And this concept, thinking about, in my opinion, one of the key components to building wealth is actually creating a mindset of a wealth builder. Now, this group, you're as I understand, you have a lot of different tactical and practical things that you do here. And I want to encourage you, if you aren't already doing it, also think about developing the mindset of a wealth builder. And what I mean by that is, there's people that have money flow to them, and there's people that actually deflect money. You've probably all people in your life. And I want to encourage you all to create a new mantra in your life for yourself, that I am a wealth builder. I call myself a blessed wealth builder, and I am attracting that energy to my life as a result of it. And I want to encourage all of you to be doing that. And there's a couple ways that I'm going to invite you later to support you in that as well. Okay. So let's just talk about the journey of financial education to start with. So, very traditionally, we're taught that we're meant to attend a higher education. It's an event, it happens in all of our lives. But sometimes I think people graduate and it's as though their learning has stopped. You've graduated, you've completed this. So what I love about this environment is you are lifelong learners, with Peggy's involvement in your life. And because the reality is, there's so many things that we all do. What about when we buy our first car? We get married, we become a first-time home buyer. What about the other things in life when we become parents and grandparents and we want to start a business, which I hope everyone in the world at some point actually gets the plan to entrepreneurship in their life. This, entrepreneurship is what this great country was built on, right? We used to be 90% entrepreneurs, and now we're 90% employees. So I love that this group is making their money work for them. An example of that is most families, they raise of hands for who has children or young people in their lives on this call. That I'm curious, traditionally, myself included, I didn't really know any better. So I simply started a 529 plan for my kids. I have 3. My oldest just graduated. He's graduating from college in April. And I did indeed save $100,000, and it cost me just over that for his 4-year education, right? But I did it in a traditional 529 plan. Now I have my second son who just graduated high school. And guess what? He doesn't want to go to college. He wants to play in his band and, do all these other things. And so now I have this 100+ K sitting in a plan that I the only way I can use it is if I take the tax penalty or I pass it on to my daughter, which I'm going to have to do one or the other, right? But now that I know what I know, most people, maybe they have that set up, but for every other big event in their kids' lives, they use their retirement or maybe their savings to help them. But we have the solution, and this is one of the things that I teach, is really can cover all the milestones in people's lives. Okay. So we have a lot of different things that we face, financially in our lives. There's, younger ages when we're in school, university, travel, maybe go out and see the world. There's, buying a car for our children. There's for weddings and buying a home, maybe supporting our first child or our grandchildren, right? Hopefully at some point people start a business in their lives. And then there's the retirement phase. There's the, costs that we incur because of health issues. There's estate planning and legacy. Now, what I love about, the reality is, there's a lot of different avenues. The financial services umbrella is massive. And usually you have to find, there might be 10 different products that could accomplish all of those things, right? But the reality is the concept of infinite banking and be your own banker really does enable you to take care of all of the phases of life if you set it up right. So the concept of the family bank, by the way, this has been around since the 20s. Most people are very familiar, I would imagine in this space especially, are familiar with the concept of infinite banking. Traditionally, it was very focused around whole life insurance, right? And the reality is, unfortunately, what happened in the market is that people were, insurance agents, let's say, that were pitching these kinds of investment strategies, they really didn't understand how these policies really could work. It was really about the commission. It was not about the mission. And it really wasn't about educating people. So what ended up happening is a lot of people got suckered into these kinds of family bank, so to speak, situations, but they weren't funded properly. So the first thing I want to encourage you to do is make sure, if you decide to implement this strategy in your life, that you work with a professional, someone that's licensed, someone that's actually educated in this space. And there's a list of criteria that I would look for. I would look for, are you a broker or are you captive? There's a very, very big difference in what that means. For example, and by the way, this is my philosophy on everything, by the way. If I can find someone that is a broker in something that doesn't have a quota tied to one particular product, that is the way that I will do everything. And that's what I love about, Peggy's environment is she does a lot of different things within real estate. She can really, define her, how she serves her client based on their need, not based on what her portfolio has to offer, right? But the family bank concept, the product itself is called Indexed Universal Life. And it really has many, many things that it can do for families. It can, first of all, protect the foundation of your wealth, which is your two hands. There is nothing more powerful than the two hands that and the wealth that can be produced from that, right? There's also an investing strategy. And what's really powerful about this product is that it has built-in market correction protection. So the market's been crazy obviously the last year, especially. You probably know the market in general is down 10% since December. 2008, we saw a 38% decrease in the market, right? There's something coming. We don't know what. I certainly don't have a crystal ball, but the reality is, if you decide to, use this strategy in your investing, you will be guaranteed that you will never, 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 never lose. Doesn't matter what the market's doing, right? You also are going to get better than market rate return. A strategy that IUL uses is indexing. It's not in the market, but it mirrors the market. What does that mean? When the market does well, the consumer goes up. When the market does bad and goes down, the consumer goes sideways. So there was a bet that Warren Buffett had back after the 2000, it's around 2007. He had $1 million bet with some of the largest hedge fund managers in the world. And he said, I will bet you that my indexing strategy will beat the market, will beat what your hedge fund does. If you win, I have to pay your group $1 million. If I win, you have to pay my charity $1 million. And in 2017, he won that bet, and he's won it ever since. And I want you to ask yourself, imagine if I have never lost anything. I've never lost a dime in all my investing strategies. How much more wealth could be created in your life? Okay. There's also something that it has as well, which is something called a living benefit. This has really been a game changer in the world of life insurance. And I'll tell you a little bit about that as well. So the IUL strategy does many things. First of all, you zero risk. There's also no age limit for you people that have young people in your lives. You can start a policy like this with a 14-day-old, okay, as long as they have a social security number. It's also penalty free, unlike most investment strategies that are retirement plans where you incur a 10% penalty, God forbid, if you took money out. It also grows tax free, and it is a lifetime policy. It's also got the living benefits that I mentioned. And it also has something very few people kind of forget about when it comes to wealth building, which is long-term care. You want to ask yourself, what are the two biggest killers of wealth? The first one is taxes. And the second is medical costs, medical coverage, what you might incur as you get older. Okay. It also has market-like returns. When you compare the last 20 years in the S&P 500 and using a floor and a cap strategy like indexing does, the S&P 500 has delivered a return of 5.52%, whereas an indexing strategy has delivered just over 8%, which that's a lot of money when you're talking, hundreds and thousands of millions of dollars that it takes to retire. And also consider what are taxes going to be like in the future? Do you think they're going to be higher when you retire? Doesn't it make sense to have some type of tax-free wealth bucket? So tax-free retirement. It's also what's called, there's no RMDs. I'm sure required minimum distributions are started. The age just increased, actually. It's now 72 and a half, I think it is. I'm blanking all of a sudden.
Yes.
But that's because Uncle Sam wants that, right? Of the money that you haven't paid taxes on yet, right? And so it's also, you're not required to, you're not required to pay RMDs on that, which can add a lot of wealth to your bucket. And it's also an opportunity to really leave that estate for your legacy as well. So Peggy, I want you to help me keep on track, because how many more minutes do we have? Are we good?
I was just going to ask you if you're ready to go into Q&A.
I was going to say, I have a couple more slides I was going to share with you, and then we can dive right in. But one of the things that I want you to consider also, just a little bit more information about the living benefit part. The reality is, 1 out of 2 men and 1 out of 3 women will face something catastrophic in their lives that won't kill them, but it will require some type of care. And so, there's really been a game changer when it comes to living benefits, because basically what that means is you can actually draw money out of your policy while you're alive and kicking, and you can use it for whatever you want to. So that's really been a game changer when it comes to insurance as well. Now, this strategy is really, in a sense, you're creating your own pension in a lot of ways. So you build cash value in these policies, and then you borrow from yourself for your investing strategies or your retirement living, whatever you choose to use it for, or simply a legacy for your family that's tax-free. So I've given you a lot of information. I didn't know much, but I'd love to answer any questions that you might have, and, just open it up for dialogue too.
Okay, thank you very, very much. Well, I have a question right off the top, because you're using an index fund and other whole life uses something different, but you get that steady 5% into your account.
Mhm.
And the money you're borrowing to invest is against the company, not out of your account. Is that the
Yep.
same with an index fund?
It depends on what the client's looking for. I have what you're talking about is sort of the concept of mutually owned companies. And that's very traditional for whole life policies. And I have some companies that I can work with that are like that. But quite frankly, when I've reviewed hundreds of whole life policies and compared them to IUL strategies. And quite frankly, I just haven't seen the whole life strategies build wealth faster. In fact, they are usually about 2 to 3 percentage points behind an IUL strategy, coupled with the fact that they also tend to have very high fees as well. So that's my personal opinion.
Okay, well, Nika
Mhm.
knows more about that.
Well,
You're
that's
an
because
index-
if you're just looking at it from that angle, but I guess, see, I was always under the impression that the UIL, or I'm sorry, I always say it backwards.
IUL.
That the IUL, you can't pull the money out as quick. And the idea, because we're real estate investors, is that we pull the money out and then we invest in the real estate. So you got to, when you're judging apples to apples of what you're creating over the long term, of what you're gaining from investing in the real estate as well. Not just
Yeah,
the
that
whole life versus the IUL. You know what I mean? You can't just stop there with the comparisons. So
well, again, yeah, you're right. And I know that there's some companies that's accurate, absolutely accurate. I work with three really. I mean, there's a lot of companies that have IULs, but the three that I like the most are Transamerica, Nationwide, and Pacific Life, for example. Pacific Life, for example, has a policy that you have immediate access to the cash. Any of those companies I just mentioned, there's absolutely an access to a portion of it. But you're right. You won't have access to all of it for sure. And part of that is because, remember, you actually are getting a product with this as well. You know, you have a life insurance benefit, for example. You have living benefits. You know, you have a legacy that you're building. So of course there has to be a portion of the cost. But it depends also what your goal is for the money. You know, I have 5 IULs and I use one purely for wealth building. I use one for my investment strategies. I use one for legacy, you know, and so it really depends on, you can have different ones, you know, it depends on your wealth and how much insurance you're able to have as well, right?
So you use those. So Nathan has 3 children that one day might go to college or not. So something like this would work for, he would set something up in his children's name. Would that be?
Correct. Yep. All of my children have one. And it depends how old your kids are, Nathan. For example, my daughter, when I first became aware of this strategy, my daughter was young enough that I could actually start it to actually use for college even. Whereas my sons, you know, one of the things about these types of strategies, they are long-term holds. Absolutely. You know, like any wealth building tool should be, right? But the reality is, this strategy, you have so much more flexibility than most wealth building tools that, you know, traditional retirement or SEP-IRAs, or maybe if you're solopreneurs, you might have a solo K, for example. Are you familiar with the solo K concept? Yeah. So a lot of you probably have solo Ks. You can use your solo K to fund your IUL. You know, there's so many different ways that you can use it.
Questions, anyone?
Yeah,
Cliff, you always have
well,
questions.
that's an
George?
interesting concept about using your solo K to fund your IUL. I hadn't been familiar with that one just yet, but yeah, I do. I love IUL products as well. I have 2. I didn't get a chance to start my kids early enough to be able to utilize it for college. But I will tell this to anybody else who, may be in that position. It's a much better product to use for, for college, for example, as a college fund than the 529, because when it's time for you to report your savings on a FAFSA, you got to
Yep.
report your 529. You don't
Yep.
report anything that's on your IUL. And so,
Yeah.
sometimes you kind of wonder, well, man, how is it the rich and famous are getting so much money sending their kids to college, and I'm not getting as much as those guys are. It's because they got their savings in an IUL.
Yeah.
On the product, your life insurance product, whereas you have to declare all of yours. So it's
Yeah.
a great strategy for that, and to alleviate the situation that Lisa's in right now, where her son doesn't want to go to college. So now that money's stuck. Whereas if it was in an IUL, she could do with it whatever she wanted to. It's
Yeah.
earmarked for college. So
I love that did you learn about the concept through your own wealth building research and things, Doug?
Some through my own, but actually I got licensed as an insurance agent about 10 years ago. I never really pursued it heavily, but a lot of my mentors were selling IULs. And so that's how I got educated at that time, and purchased, my first 2 IULs as well. So being able to overfund it is what Lisa's really stressing here. I still don't really know. I'm interested to hear how I would utilize that to turn myself into my own bank. I understand about taking out a loan.
And I'll give you an example on that. So I have several. I have one IUL that I use it for my larger big business expenses. So instead of putting it on a credit card and then, using my revenue to pay it back, I just invested in a software system for a company, and it's a, comprehensive marketing system and software platform, and it cost 10 grand. I borrowed from my IUL, and I'm using that. I'm going to put it to work, and then I'm going to pay myself back over the next couple of months. Right. So, personally, there's so many ways you can use it, obviously. Right. But I love the fact that you have them for your kids. And if you haven't yet, learn about how you can really use it for real estate. I'm going to put my calendar link in the chat for you guys. Feel free to schedule some time with me if that resonates with you. Another thing to think about, since you're all wealth builders here, is the industry, that of becoming your own bank. The industry of, just let's say, the umbrella of financial services right now, in general, it's the highest paid industry in the world. And I am always looking for, like Peggy and I are talking about ways that we can collaborate. My community could be served by investing in real estate, and hers the same way, and we have powerful affiliate partnerships that we create, that, I'm the one that has passion in this space, but you probably know people that could benefit from it. And I pay very well for those referrals. So another, great wealth building tool, just to give you an example, the Amazon, retail space is a $14 trillion industry. Amazon doesn't own any products. They simply distribute products. Well, to compare it, to the financial services industry, it's a $63 trillion industry. And again, I don't own any products. I just get to be the professional finger pointer and educator. Does that make sense? So if that resonates with any of you, also, I love that you have your license, Doug. I wish more people did. It sounds like, Nika, you have your license as well. Is that right? Cool.
And I think Cliff also.
I just got it, ma'am.
Nice.
So,
Okay. Super.
So Doug, you could borrow the money for your children, or your children could borrow the money for that and then put that in some of the real estate. So my question for everybody's information, I'm asking this question. So let's just say that Doug takes, invest for his 2 children, or his 2 children decide they want to invest and they now have let's say they put $25,000 into something that's 100% return, and in 3 years, they are now have $25,000 profit. So they're going to pay themselves back their 25. Are they going to have to pay taxes on that other 25 they made?
They won't have to pay any taxes on money they've taken out of their IUL.
Right,
Because
I'm
life
not
insurance
asking
money
about
is
that.
tax-free.
I'm asking
That
about the
that question
profit.
on the back end is above my pay grade. I don't know about taxes. I'm not a tax person.
Okay,
So I don't know about that.
so they can't put the whole can they put the whole 50,000 back into so they borrowed 25, they made 25,
Yeah.
50, could they put the whole 50 back into the index fund?
So it depends how much room, quote unquote, room there is in the
Okay.
policy. Yeah, so I'll give you an example. I have one policy that I set up and I am minimally funding it. It's a $1.6 million policy. I can actually save up to 120,000 a year in that policy, but I'm minimally funding it. I'm not funding it entirely because I know that more wealth is coming. I know I'm going to, I have some investments that are coming through. I have an inheritance from my father that I'm, whenever he goes, he's passing on to my brother and I. So I have a place to put that, right? That is going to be able to be protected from taxes in the future as it grows. Does that make sense? And there's a law that just passed in January. It's an IRS code. I'm blanking on the number, but it's become even more profitable for people to invest in life insurance because it's raised the value of what you can invest.
Thank you. Seema.
Yeah. So, oh, sorry.
Yeah, Seema has a question. And you're muted, Seema.
Okay, there we go. So I know that Doug asked the question, which I was going to ask, that is it better to have a 529 or an IUL, because everybody has a 529 now. And this is like amazing if you don't have to report an IUL to the IRS when you're doing that stupid application, And
Yeah.
so what if, my girls are at the other end of the spectrum, but can you start it for people who are not your kids?
Your kids,
Great
grandkids,
question.
yes.
Great question. So there's a couple ways that you can start a policy for someone that is not your living relative, for example. Now, let me ask you, Seema, are you planning to fund that? Or are you in order to build wealth for them? Or is this what they would be contributing for themselves?
Well, no, I had been toying around with funding certain kids 529, but
Yeah.
but if an IUL is better,
Yeah.
then I
How old
think
are your kids?
well, no, my girls are at the other end of the spectrum.
These are these like grandchildren or just in general children?
Yeah, I wish I had grandchildren. So
Yeah.
don't get me started on this. This is so subject. Little do you know. First, they need to find men. I know they don't need to, but it'd be better. But these were. I was hoping to get some capital gains, and I was some of my daughter's friends' kids, and they all have 529s, but they can't put that much. And for a 529, you can super fund it. You can put 5 years worth of contributions in it, and anybody can do that. You don't have to be related but an IUL would be great. And I know you can only give away $16,000 a year to random people, which is also not bad. If you could even do that for I'm saying a random person, though it'll be somebody no,
right.
But if you can do that, then can their parents, and then their parents can do the investing and stuff, or
I was gonna say, that would be my recommendation.
that kind of thing. Cool.
For example, and there's different roles that there are in a life insurance policy. There's the insured, there's the beneficiary, of course, there's the payer, and then there's the owner, you know,
Okay.
and so depending on the relationship, there's different things that you
Cool.
can do.
Okay.
Yeah,
That is
exactly.
great.
A
Okay.
really powerful one too, if you have, for example, maybe you have partnerships that you've created in your real estate business. You can also have what's called key person insurance on your partner, for example. It's a very powerful way to ensure, you know, let's say one partner was fully invested, their husband or wife was just as much part of the business, right? And then one partner, they were invested, but their family wasn't. You know, so this partner passes. The key person insurance enables that there's either the ability to pay the partner's family off, or find someone else that's going to be able to contribute in the way that they did, you know? So we do a lot of key person policies as well for partnerships and things.
That's great. Thank you,
Yeah.
George. And then Lisa.
I'm trying to understand better how this works for the insurance company. And I'd like to contrast it with when you work with a bank, for example. You can have a certain number of assets, maybe a stock account, and suppose that your account doesn't go down, there's no margin call, you get to borrow a certain percentage against that. But I mean, this seems to kind of go beyond that. And how is this really, I guess just to bring it all full circle, I feel like if I don't understand how it works for both sides, I don't fully trust it. And that's kind of where I'm
Yeah.
at with this.
Yeah, that's very good question. And there's a great book that I can send. I'll send Peggy that I can pass on to you all. It's called The Retirement Miracle, and it's a great starter book to understand this concept. But in a nutshell, let me share exactly what happens, George. So you're probably wondering, how can they guarantee no loss? How can they guarantee that, you know, when the market goes up, we'll win? And then it's like there's a new layer of concrete poured in your investment. So what happens is, let's say you are starting, I'm just giving round numbers. You're going to start a $100,000 policy, right? So what the insurance company does, first of all, they underwrite you. Is George a good bet? You know, the reality is with life insurance, by the way, friends, only 2% of life insurance actually pays out. Now I'm talking we're talking more term insurance, right? But the reality is, it's the most lucrative business in the world. If you actually look at any Fortune 100 or 500 company that's publicly traded, you know how you can actually see what their assets are. And do you want to know what? Most companies, the amount of money that they have in insurance is 20 times what they have in real estate, for example. And this is why. Okay, so first of all, is the company pretty much going to guarantee that at some point that you're giving them your money for as long the rest of your life, basically? When you enter into an agreement like this, the reality is the goal is that you're making a long-term commitment to them. Okay, so what they do with this is they take a portion of George's premium and they put it in something probably about 85% of it. They put it in a place that they know their returns are going to be probably 25, 30%. They're highly speculative. They win a lot, they lose a lot, but overall it's a very, very strong rate of return, right? With the other portion, they put it in something very sure, very secure, something like a bond, something, you know, that there's guaranteed they're not going to lose, right? So over here, they're making a whole bunch of money. They can guarantee you that you're not going to lose. It's such a small fraction of what they're guaranteeing to you. So that's very, very fundamentally the concept. And what happens when you borrow from yourself, basically, really all you're borrowing from, George, is you're borrowing from the value that they've been speculating on. You're borrowing from whatever you've accumulated yourself, you're borrowing from yourself, right? And what happens when you pass is if, you know, whatever you've taken out that you haven't replenished, for example, they simply take off from the face value of the death benefit. So it really becomes like, you know, it's winning for them because they have George's lifetime of investment, right? but it's also winning for you because you're able to create your own pension in a sense. Make sense?
Yeah, awesome. That's helpful. They do
It's a
have that
very
death benefit at the
rudimentary
end.
way to explain it, but I know.
Yeah,
I agree
helpful.
with you.
I've even interviewed people that talk about the infinite banking concept, and I still
Yeah.
feel like there's a few wrinkles that I've got to get. But yeah, great, very helpful.
Yeah.
Thank you, Lisa.
Absolutely.
Thank you, Lisa. Lisa McCrellis. Yeah.
And Angel's with me too, my
Oh,
husband.
good. Hi, Angel.
Hi. Actually, we have been introduced a little bit about this because as Peggy knows, I have 3 kids who are one isn't already in college and 2 more are coming in, and they're overlapping. So whenever we do that FAFSA thing, of course, we don't get any kind of financial aid.
Yeah.
I don't know if
Yeah.
it's or not, but yeah, because of the income level. So we actually met with one of the it's like a
College
advisor, a college planning advisor. And what he told us is to put to shield some of our
to use a level premium whole life
insurance policy.
to basically put some money there so it's not going to show up on college applications.
And
Mhm.
and then whenever we need it, just withdraw from that. So
So my first question would be, how much does that advisor know about infinite banking and the be your own banker concept? Um,
okay.
that would be and that would be what I would, if I were in your shoes, that's what I would ask them, you know? Because the reality is, and I'll tell you, friends, I can't recall if I shared this with you. I've been in financial services for 25 years, and I know the industry like inside and out. And I would say 99% of advisors have no clue about this strategy, no clue whatsoever. And it's not their fault, by the way. It's just the way the traditional industry is. They're paid on quotas. They're paid, they have a book of business. They have minimums that they have, and the reality is they're not paid very well on insurance products. They're just not, they're paid much better when you have assets under management that they're managing. Traditional advisors, you pay them a fee. It's usually 0.5 to 2% of assets under management. And guess what? You pay that fee whether you win or lose in the market. I had 2 advisors I worked with back in 2008. I had one guy I followed for my husband's assets, one for my assets. Both very nice men. Don't get me wrong. I love to empower women with money. Sorry, boys. I just, in general. But they never really taught me anything. They both really didn't do much better than the other. And it didn't stop me from losing 30% of the market in 2000, like everybody did, So I don't agree with that strategy personally, but it's just because of what I know about infinite banking and how much better what's called an increasing value policy is versus a level death benefit.
Okay.
They did say whole life insurance. They didn't say term.
Yeah.
Yes,
And
that's
whole
true.
life is the banking.
We don't know exactly what the name of the product. He did tell us about it. It's just something that you put like a chunk of money, and then every time we need to use it, you can just draw money from it because
Called overfunding.
Yeah, it sounds like an overfunded whole life policy is my guess.
Okay.
Yeah.
So
The label is level premium whole life insurance.
Mhm. Yeah.
yeah. So yeah, we're not. That's why we hit pause on that after he gave us that, because we still need to. We said we would think about it.
Well, and I'll give you an example. There's a very big fallacy in the market where you have to have a lot of money to create this type of wealth building. I just helped a single mom who could save $50 a month in her own bank. A whole life sellers, though, that sell infinite banking tend to be very, very much catering towards the wealthy, the very, very wealthy. And I help help the wealthy. I help the single mom like myself who could save $50 a month, you know, but my goal really is really just helping people create a foundation of education around this space, right? Because imagine, you know, when the next 2008 crash happens, whenever that's going to be, it may not be as bad as it was, but the reality is history repeats itself in numbers and finance. That's one of the things I love about finance is numbers don't lie. You know what I mean? And so if there's value that you can build in your own life, that, by the way, I would say is exactly the opposite of how most people are building wealth, because most people aren't on, you know, shows like this trying to learn. You know, most people are like, they spend more time on their vacation than they do planning their financial future, you know what I mean? So you guys are already a different type of population. And so, by the way, don't go out and ask your neighbor about this who knows nothing about it. Sit down with someone like me or someone in your community that's licensed, first of all, that has knowledge in this space. And that is, I consider myself an educator. You know, I am licensed in all 50 states, so I can help you if you decide to execute this, but I'd rather actually teach you some things too. Does that make sense?
Okay. Thank you.
Okay, thank you. And we're almost at the top of the hour, and here's Doug. And Doug, you'll be our last question
Okay.
or comment or whatever you have.
Yeah, sure. I just wanted to speak to a couple of the things that you guys have brought up. For example, the last couple, to make sure we understand when it comes to overfunding, it is possible to overfund a life insurance policy, but only by a certain amount. Okay. Yeah. So every year you have a minimum amount that you need to pay towards your cost of insurance, but there is also a maximum amount that you are allowed to pay towards your cost of insurance. So most policies, if not all, I think, are set up to where if you pay the full term, like you have your minimum policy, your minimum payments, and sometimes you can set those minimum payments to last for 7 years, 10 years, 20 years, or for the life of the, of the not patient, of the protected
Policy holder.
Yeah. Yes, the policy, man, I couldn't get out. So it's for the lifetime. You can continue making payments for the rest of your life. But typically the shortest amount of time that you can pay is 7 years. So let's just keep the numbers, simple. If I have $1 million policy and I'm going to, over the life of my policy, pay out, I don't know, $70,000 towards that life insurance policy, probably more, but let's just keep the number simple, right? Then that means that at most I can overfund my policy $10,000 a year for the next 7 years. And at that point, I reach my $70,000 maximum. And that is the most that I could put in, and the fastest that I could put it in, at least the fastest that I could overfund that policy. At that point, if you have what I have purchased for my children, an increasing policy, so that my $1 million is not just capped at $1 million, it grows as my cash value grows, then I'm able to allow that policy to continue growing larger and larger. But let's just say in the first couple of years, I didn't have the money to overfund it. I didn't put in 10,000. So the next year I could put in up to 20,000. And in the third year, I could put in up to 30,000. So that's one of the benefits of you having a policy like an IUL for some time. Maybe the first couple of years you couldn't overfund it. But then, hey, like Peggy mentioned, I get into a situation where I double my money. Now I want to put that money back into a policy. Is there room for me to do it? Could be.
Yeah,
you had
it's
not-
and it's based on the face value, like you said. There's a target, what they call a target, and a guideline. Guideline is, okay, you can't put any more without hitting a MEC and then making this a taxable investment, right? So
Right.
yeah. And you know what I love about that, what you said, Doug, and again, a very powerful differentiator between traditional wealth building, because as you know, your tax accountant's always going to ask, hey, what are your IRA contributions this year? And it has to be in by April 15th. But like Doug says, say you make a great windfall in an investment, you know, maybe you just target fund it for a couple of years, but then you can back fund it. Depends on the company. It's usually 7 years. But yeah, I love that you said that. It's really powerful.
Yeah, and
Great.
so maybe one last strategy, because I know we're running out of time. When it comes to buying an insurance policy, like someone was asking, I think it may have been Seema. So, hey, who all can I purchase a policy for? Who can I fund a policy for? I believe if you were trying to help your daughter's friends' children, you wouldn't be the owner of that 529 policy anyway. So if you wanted to give to them, it was fine for you to give them a gift. If you want to do this in an IUL, they would have to purchase the IUL. You wouldn't be able to be the owner if that person was not in your, line of, in your family, one of your kids.
No insurable interest.
Right.
Yeah, exactly.
But
Yeah.
But for those of us who do, like, for example, I just had my first grandchild born. I'm purchasing a policy in Marlowe's name, and I am overfunding that policy. Now, that benefits her, obviously, but it could also benefit me if I so choose, because I'm the owner of the policy. Therefore, I can do with the cash value whatever I choose to do with that cash until I then pass the policy on to her. So maybe we say, well, wow, I'm 50, years old. The cost of insurance for me is quite high. So it's going to take me a while to build up a large cash balance. Well, that's not true for her. Her cost of insurance is low. So I'm going to dump the money into her policy as opposed to my policy and allow my cash to grow there as opposed to with me, if that makes any sense.
Baby plan.
Say again?
They call it the $1 million baby plan. I love that plan.
I'm not sure. I got two.
Yeah, that. I think I heard though that you can't put as much in with the baby. Someone told me, I was like, darn,
Yeah,
when they're too young, I think it's a smaller amount that you can create it for, but yeah.
Could be, yeah.
Well,
it's based on the product, too.
It's based on the insurance that the parent has. So you
Yeah.
can't, for
Oh,
example,
right.
it's based on, it can only be, the max is 500,000 at the moment, at least.
Ridiculous.
And, and it depends on the family's total net worth as well.
Yeah.
Which makes no sense to me because you want your kids to be better off than you. Every parent says that. So children should be multimillionaires by the time they hit 18. Anyway, let's conclude the day. And thank you, Lisa, for your information and how fantastic it is. And I'm sure some people will be giving you a call. And thank you very, very, very much.
Thank you, Peggy. It's been a pleasure. I appreciate your time as well.
Thank you so much. Very informational.